Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're speaking about KEC International, and it is a pretty set of numbers because it's a beat on all fronts. Consensus estimates beaten on the PAT number as well as on the top line, and there has been an expansion in the margins. We'll talk about the reasons that have contributed to this performance. We're joined, in fact, by the management, Vimal Kejriwal, the Managing Director and Chief Executive Officer of the company, joining in. Mr. Kejriwal, thank you so much for joining in. And before I delve into the fine print of this, could you take me through what your key takeaways from the quarter gone by were?
I think we had a good quarter, I'll say, after some time. Okay, last few quarters had been under pressure because of commodity prices and other issues. So this quarter, we have been able to manage, I'll say, virtually all the items, whether it is the revenue or EBITDA or PAT, all three of them, we are about 25%. And even the order intake for the quarter or a YTD has been 4,500, which is 30% above. So I don't think we could have asked for something better for the quarter that way.
Fantastic. So I'm glad that you pointed out that 30% uptick in the order inflow. But before we get to that and which segments most of the orders are coming in, I would also talk about order execution and what bearing that has had on the operations during the quarter gone by. What can you tell me about the key strides made in that particular area?
So if you look at our various SBUs, we have businesses in transmission, then we have railways, we have civil, cables, etc. So the maximum growth, as usual, has come from civil. Civil has grown by close to 60%, almost touching 1,000 crore revenue for the quarter. This is on top of the 50% growth which they had overall for the year last year. So that's clearly an outperformer in terms of physical execution. And the second one I'll say is transmission and distribution, both in India as well as international, especially in the Middle East, etc., where we have done very well, and some part of the former Soviet Union, where we have got projects in Georgia and Moldova. And even those projects have done well on the execution part of it.
Understood. Now, when you're talking about that margin expansion, 5.08% was the comparable quarter. 5.75% is what you've achieved in the quarter gone by. What are the key contributing factors? Was it, as you said, input costs, or were there other factors at play?
So I'll tell you, there are a couple of factors. One of the biggest factors, I'll say, would have been our Brazilian operations. They had lost money in the corresponding quarter, whereas this quarter and even the last quarter, they were EBITDA positive. SAE as a whole, our America's entity, is PBT positive now. So I think that's one major factor which has helped us in turning around on the EBITDA front, and also the increase in the revenue of civil, which is a decent margin, and in T&D, as you rightly said, that with the commodities having stabilized, we have started making better margins. Although there's a mix of projects, it still has some legacy projects. So some of them we have completed this quarter, some of them we will, I think, balance will complete in quarter 2. So that's the reason why this has happened.
What is the quantum, if you talk about the value of those legacy projects? How much of that is still remaining on your books?
So I think it's around 2.5-3% of my order book, which would, if you would translate to a 30,000 crore order book, would be 800-900 crores of orders. But a large part of the losses were more on account of metals, which are already hedged. So a large part of the losses have already been accounted for. But a little bit more may come depending upon, how much claims we have from the client, what happens and how quickly we can finish it, etc. But in some cases, there are some ROWs which are on the client account. But I'll say that's not very significant. But whatever impact is there, I think we should be able to cover it up in Q2.
Now, you say that civil is the biggest engine for growth for you, but I see transmission and distribution as well. If I look at the order intake, over 40% of that in the year-to-date period has come from that transmission and distribution. It's about 44% or thereabouts of your order book right now. So wouldn't you say that is a very promising area and you're getting a lot of business there?
So Alex, what has happened is the last 2 years, or I'll say almost 3 years since the COVID, the transmission distribution had not been doing very well. But suddenly we have seen that it has turned around and it's doing very well. Okay, so it could be a balance, race between transmission, distribution, and civil. Obviously, the absolute value of transmission distribution is very high. Even in the current year, If you look at the entire year, we'll do more than 10,000 crores probably in revenue in transmission and distribution, whereas civil will do only 5,000. When you look at the relative growth, transmission and distribution may grow by 20%, but civil will grow by 50%. I think that's the basic difference.
Understood. So talk to me about that civil part of your business, and talk to me about why you believe that it's such an engine of growth and the prospects that you see both in this financial year and over the next couple of financial years as well.
So there are two parts to it. One is geographical. So we have not yet got a single order. We just started looking at international, we started bidding. So some growth will definitely come in the order book this year, maybe not in revenues, but revenues next year onwards, we should see some part of international. Now, we are there in various segments in civil. We are still not there in some of them. But if you look at the major segments where we are there in water. That's a water supply, Jal Se Nal Tak. So there we are doing very well. We are there in urban infra. We are executing some 7 or 8, viaducts and all that. But I think the biggest one, I'll say growth will be from residential. We are right now doing almost 40 towers. And we are seeing an inquiry flowing in on residential virtually I'll say every day. Okay. So there's a huge amount of tenders which we are seeing in the residential side. And the second one, I'll say, would be on the metals and mining. Primarily, I'll say steel, huge number of inquiries coming up. Other industries, you just started seeing some pieces of it coming in. But to me, these are the segments where we are doing very well. And I think the last one I'll say is data center, where we are doing 4 data centers and again, a lot more inquiries coming up. So we are seeing actually a large growth coming up on the tender side in the civil business. Plus, there could be segments like hydrocarbon, all where we are not there. So I think to me, the opportunities for growth in civil are significantly high.
From an operational standpoint and also from the bottom line standpoint, I'm just trying to understand what the implications of that are. If you're growing at 50% for your civil business, one would assume that over the next couple of years, you would see a larger share of the pie going towards civil. What are the implications for the bottom line then?
So civil, I'll say that if you compare a typical margin of T&D, it would have been higher. But last few years, T&D margins have been lower. Okay, so difficult for me right now to talk about what would be the implication on margin. But our view is that we would like to have most of the businesses earning a similar margin. Okay, that's the way we are looking at the businesses. However, the advantage of civil, other than margin, has been the lower working capital. If you look at the net working days, etc., of civil versus transmission, probably civil would be, I'll say, around 60% of the net working capital. So the advantage which we have in civil is that you can expand a lot on the civil side without putting in too much capital, which would be required in the T&D. I think that's the major difference.
Now that you mentioned working capital, I'm just curious because I'm not totally able to understand why there has been an over 800 crore increase in the net debt on a sequential basis. Why is that? And I also understand that so interest costs up at about 58%, correct me if I'm wrong. And that I think has had a bearing on the PAT number as well, which I think could have been higher if that was not the case.
So Alex, one thing is that in our business, seasonality plays a very big role. If you look at the numbers over the years also, the Q4 would typically be between 35 to 40% of revenues. And the other 3 quarters are typically 20%. So I'll say broadly. Okay. And also the working capital, every year we have seen that in March, the working capital and the debt always comes down. If you look at year on year, our debt has come down. Our net working capital has come down. Okay. But typically what we've seen is that because we'll have almost, I don't know the exact number, 70 to 80% of government clients. And we do see a lot of payouts happening in the March on account of budget constraints or whatever is there. So people want to pay out very quickly. So every year we have seen this phenomena where in March your debt goes down and in June the debt goes up. Am I worried about it? I don't think we are worried about it because you have to also understand that our business has grown by 28% for the quarter. And we do expect that for the year again, we will grow significantly and the debt would be required for that purpose.
No doubt. And thanks so much for that clarification. I'm asking about railways as well. From what I can see, it's about 15% of the order book as things stand. But I think there's a lot of action that you're seeing in that space. And it seems that a lot of projects are being won. You've pointed out the prospects as well in your presentation, and you've spoken about the train collision avoidance system, TCS, or the Kavach program and the prospects there. How quickly can you see a ramp up, and what advantages or what potential do you see in that business?
So as far as we know, the overall potential in that business is 25,000 crores for the entire industry.
Okay.
Okay, whether it comes in 2 years, 3 years, it depends upon how the government wants to do it. Also, it's in a way constrained by the capacity of the OEM manufacturers. Right now, there are 3 approved manufacturers. I think government and RDS is looking at approving another 2 or 3. So that's in my view one constraint on how quickly you can roll out the Kavach program. As far as the figures which I know, they have come out with around 1,600 crores of tenders in the last year, where we also won 2 of them. There would be another 2,500 crores of tenders, I think, coming out in this financial year, and the rest would probably go on to the next year. I think that's the way it is. So if you ask me number-wise, it could add probably 400, 500 crores or something like that to my revenues. I don't see it as a major revenue earner. Okay, obviously with a limited number of players and all that, the margins are slightly better, and it also gives you a technologically edge. So that way we are very happy to do it. But will it add significant numbers? I am not very sure about it. But it will add numbers, yes.
Fantastic. So then I will go back to the overarching question that I had at the start, and I thought I'd wait to get some clarity on the various business lines before I got to this. About 30% growth in the order book, which suggests that there is a lot of promise for this financial year. And I think we're hearing this from a lot of players in the market as well, that there is a substantial amount of investment that is coming in, right? So from that perspective, do you think that this run rate can be held through this financial year, that 30% growth in order book? And what can you tell me about execution in the remainder of the financial year?
So Alex, I am not sure whether we'll be able to maintain the 30% growth rate. Because if you look at our order intake last year, I think it was around 22,000 crores. This year, we only guided for 25,000 as far as the market is concerned. So I think 30% would be difficult to maintain unless, we suddenly see some very large orders coming in. Okay. So I would rather restrict it to, let's say around 15% or so at 25,000 crore number.
You're retaining your 25,000. You don't think that based on the orders that you've gotten so far, you might just go past that number?
No, I don't think we would like to go also. Let me be very honest with you, because I think we have had issues on our profitability, etc. earlier. So, and also working capital, as you rightly pointed out. So I think we have been a lot more focused on the quality of orders which we are winning. Okay. How do we improve the margins? How do you get into better cash flows and all that? So I think we already have a 30,000 crore order book with us and 5,000 crore L1. So even if I do 25,000, I think I have enough in my backlog for my next year's growth.
That's an understatement, if at all. Mr. Kejriwal, a pleasure speaking with you, and thank you so much for joining in, for speaking to BQ Prime. Always a pleasure.
Thanks, Alex, for having me. Thank you so much.
All right, viewers, there you have it. The management of KEC International, certainly a stock to watch out for. Do stay tuned. Lots more coming up over the course of the day. This is BQ Prime.